Thanks so much for tuning into this earnings conversation with the management of Metropolis. Ameera Shah joins in right now after putting up what seems to be a pretty good quarter compared to Bloomberg estimates. Revenues up about 6.17% at 291. Net profit slightly higher than the Bloomberg estimate too, but the real deal was the EBITDA, which after a positive surprise in Q3 has once again beaten estimates quite handsomely, with margins clocking in much higher than estimated. Ameera Shah joins in. Ameera, good having you. Thanks for joining in. I hope all is safe.
A pleasure.
Now, put the quarter or put the last half into perspective, Ameera, because it was a half that was kind of punctuated with we coming out of the COVID crisis and then starting to go back into it. Was it difficult to manage the operations, and how would you classify Q4 performance?
So the year has been a roller coaster, for all of us, I think, and obviously for those of us who are in healthcare and those of us who are in healthcare services and diagnostics, it's been quite crazy. But, as we saw the first quarter complete lockdown in India, the non-COVID business got very badly affected because even essential services were in lockdown, and therefore patients were not even going to doctors, hospitals were not functioning. So I think that was a really abnormal quarter. Things started to get a little bit more normal in Q2. However, non-COVID had still not come back to normalcy. COVID actually surged in September. We came to Q3 when non-COVID actually normalized, and COVID was more muted. After, of course, it was high in Delhi in that month, but then it came down. And Q4, we've seen non-COVID move into a positive zone, and of course, COVID to come back in end of March. So it really depends on which geography you're stronger in. You've seen a different quarter result in a different focus. As we know, COVID has surged again in April. And usually what happens is when COVID surges, obviously the COVID testing and the allied tests surge, but the non-COVID actually gets dented. Depending on the strength of the lockdown in the state or in the region, the amount of non-COVID gets affected. So we have seen some states which, even though in lockdown, we have not seen it get too badly affected, like in Delhi. But in Maharashtra last year, in the first quarter when the lockdown happened, there was really strict lockdown. It's very, very strictly enforced, and therefore we had seen it completely fall. But this year I expect COVID to continue through the year. It is not going to be, unfortunately, something that we see only now. I do expect to see a third wave, sometime in September, October. And this particular wave, while it's out of metros as of now, it's still there in Bangalore and Chennai. But while it's out of Bombay and Delhi at this point of time and other big cities, it has moved into the smaller towns of Maharashtra, of Uttar Pradesh, West Bengal, Bihar, MP, Jharkhand, etc. So it will go into July till we see, or the end of June till we see this particular surge end.
Well, yeah, that's not pleasant news, but you're calling us to pay the spade, which is great. The question, therefore, Ameera, would be that would it be nearly impossible to give a sense of what business will normalize in which quarter? Because there's so many micro parts moving around.
There are so many moving parts. It's very difficult to say. So my estimate is that while non-COVID will be slightly affected in this quarter, in Q2, I think we should see non-COVID be more stable. Because COVID, I don't think will be a significant part of our reality. And then my estimate is Q3, like I said, as COVID surges, we will probably see again non-COVID get a bit muted. So, it's really all going to depend on how COVID moves from here. And a lot of the suppositions are based on that.
Okay, just a quick follow-up to the one thing that is probably in some ways in your control, and which is the cost, right? You did a great job in Q3. You followed it up with a pretty good operational performance in Q4, actually very good operational performance in Q4. Have you kind of cut down the flab to almost the bone? Or do you reckon that if indeed there are some unpleasant external events around, you'll be able to manage this and therefore throw up a healthy performance even then?
I think the margin expansion has happened for 2-3 reasons, right? One reason is, of course, there is economies of scale benefit that comes in through large volumes of COVID testing. Even though the unit economics of COVID are very challenging at this stage with the lower prices, but when you look at it from a group basis, at the infrastructure we've already built, it adds a little bit to the bottom line on a group basis. So that's one. The second is we ourselves have done a lot of work behind the scenes in terms of automation, cutting the flab, improving efficiency, improving productivity, and some of those benefits have also spilled into the margin. And third has been the mix of channel mix and product mix. And that again has given certain tests and products and categories which were higher margin have actually contributed. So I think it's a combination of these three. I think 21, 22, considering that COVID will probably continue, but prices is something that is not in our control. Assuming the prices are stable, I think we should continue to see that coming in. On the expansion, organic expansion, we are actually planning to add 90 labs in 3 years and 1,800 collection centers in 3 years' time. Currently, we are at 125 labs and 2,500 collection centers. So that basically means we're almost doubling in 3 years, which means that there will be some hit on the margin, obviously, because of operational losses for these labs initially. But what we are doing is we are working simultaneously on other cost management initiatives so that we can neutralize that effect and at least make sure that margins sustain going forward. So if you actually look at it, our margins this year in 2021 have been about 30% EBITDA for the year. And we are hoping to be able to sustain that into next year.
Which is great. Considering the expansion that you have, just a quick 2 follow-ups. Since you brought about this expansion, would this largely be, you mentioned organic, right? So the inorganic moves, if any, are not baked in, will be separate. Would you need to raise any kind of major fundraising for the same, or would internal accruals
for the organic expansion? No, we currently have 400 crores plus cash on our books. So we are very well funded. We expect the organic expansion to cost us maybe 30-35 crores over the next 3 years in terms of capex. Obviously, the OPEX I already mentioned to you that we would have seen a bit margin dilution of maybe 75 to 100 bips on the margin, but which we'll cover up with other cost initiatives. As far as the collection centers, they're all on an asset-light model. So therefore, there's limited capex that will go into there. So we don't need to raise any capital for that. Of course, if we do any large acquisitions or transactions, then of course we would look at raising debt or raising equity from the markets.
Okay, and as like the one that you just very recently did as well. Just quick follow-up, Ameera, on the other aspect, which is that you taking a leaf from your first answer, wherein you mentioned that now it seems to be just moving away a little bit from the metros into the rural areas. I presume, and please correct me if I'm wrong, that you hitherto follow that hub and spoke model of cities and some micro cities and not as much into rural. And please correct me if I'm wrong. So therefore, would it be safe to assume that by virtue of that strategy, you might be slightly better placed, because while COVID impacts rural, it will not impact your core operations as much as it otherwise would have?
So, I mean, COVID has already impacted our core operations in cities. That's where it started, right? And now it's moving into rural. So yes, going forward, whatever impact happens in June will happen less effect on us, because we tend to be more in metros and tier 1 and tier 2 towns. So as it moves more into rural India, yes, it will impact us less. But one of the other changes that I'm expecting to see is population movement changes in India. We are seeing a lot of people who had moved to cities from small towns are now saying, why should I live in these cities? I can, work from a smaller town. Hopefully my company will give me the flexibility to do that. And I think we might start seeing people actually moving into smaller towns as well, which means infrastructure will need to follow them. And rather than them seeking education and healthcare in the biggest cities of the country, maybe the education and healthcare will follow them into smaller towns. And that's part of our thought in also this expansion of the 90 labs, is saying that, look, in smaller towns, how can we go and actually establish our labs and provide healthcare there to people where they need it? And that's part of that theory as well.
That should be pretty interesting, and it should make for interesting conversations, the learnings from it as the year goes by. I mean, one final question. You are reportedly wanting to expand the B2C share from 45% to 65%. I know strategy questions might sound a bit meaningless, but be that as it may, would you reckon that if, as and when you reach that, or in the journey, it would be return ratio, operational metrics, accretive a move? And can we see signs of that happening from FY23 or FY24 itself?
So actually, this move of 45% to 65, was a target we set a few years ago, and we've actually made significant progress on that. And this target was really for the focus cities, which are 5 cities which contribute a large amount of business to us. So we've already reached about 58% on that journey, which we started 3-4 years ago. And part of this progress of 45 to 58% is the accretive margin expansion that you are seeing, because as our B2C increases, it does give us a better margin profile, and that's what you're seeing actually come into the margin play as well. As I mentioned to you, the channel mix and the product mix, that was part of what I was referring to.
Okay, excuse me for that, but I wish you all the best, and I'm not asking you too many revenue forecast questions because I'm guessing it's just impossible to do that.
It's impossible to gauge, yeah.
But thank you so much and all the best. Stay safe.
Thank you so much. Nice chatting.
Likewise. Viewers, thanks for tuning into this conversation.